Welcome to Markets Now. I'm Michelle Rook with John Heinberg, Total Farm Marketing. Over in the grain sector today, corn and soybeans lower, wheat to the plus side, cattle had a down day, but hogs did end higher. So John, let's start off talking about corn and soybeans. We made some new lows for the move, some 4-year lows at that. How much more downside risk do you think we have in these markets? And is this just about yield, or is this also about demand?
Well, in my mind, there's still some more potential, especially with the closes here as we've taken out the $4 handle in December corn. It's just such a big psychological level. Obviously, how we kind of close out the week, I think, will be very, very key with the trade tomorrow on Friday. If we get a little recovery, maybe that just gets us sideways for a bit here. But right now, I'm still talking the 350 window for December corn. I look at the September contract. We got a chance here, too, that we could see some, pretty aggressive selling, especially if producers are moving bushels. That could point to a 340 target zone if the selling really were to kick in. It's a combination of things. I mean, obviously, the supply side is what's well documented. We'll see what some of these private analysts start coming together for projections as we get ready for next week's USDA report. But on the top of it, though, too, to me, it's still about demand. I mean, we got to get through the supply side that's building, and we're just not seeing enough activity, especially on the export market. I mean, for corn, at least the ethanol side is very, very strong, but we need some sales on the export front that will move the needle. Right now we've been seeing nothing but routine sales, like the one in beans today at 130,000 metric tons. That's not a lot when you're only looking at 3-4 million bushels. In terms of this whole supply pile, we need some more aggressive work in that selling side. And I think this market's going to think about that, continue to push prices down to maybe we find that point where the demand finally does kick in.
Yeah, we've been really fixated on yield here, and I know we're going to get some average trade guesses going into the WASDE, but we are trading, above 181 and 52 that USDA gave us on the last report, or not?
When you base things off the yield, some of these yield models that come off the crop conditions, we're looking at possibly at 183 to 185 is a number I'm hearing buzzed around out there quite a bit. So we'll have to see how that puts together. Now, there's a couple things that are on the radar that we got to watch for. I mean, USDA did put out an announcement yesterday that they're going to be looking at all data regarding acreage and things of that nature for next week's report. So maybe we get some adjustment there. Nothing promised, but they're going to look at it at least. So we'll see. But even there, if we even lose 1 million acres of corn with the potential yield we got, it all kind of comes out in the wash. And we're still going to have a heavy supply pile that we need to move. Therefore, it keeps coming back to me in that demand side of the equation. We need to see those sales start picking up for both corn and soybeans.
Yeah. So how low do prices need to go, John, to start stimulating the kind of demand that would move the meter?
A lot of it's still depending on where we are on the competitive side against the South American prices or other prices of grains. And, right now we're still kind of in a fairly competitive spot here, but, Argentina corn's going to make it difficult for us to really rally because they'll shift their momentum that way. Also, there's other factors. Look at the currency side. Look at the Brazilian real and what that does to soybean prices. That's down there challenging recent lows in terms of its value against the dollar. So, to kind of answer your question, it's a hard number to peg. There's psychological levels. If we get to 350, that might be a trigger point that, some of these end users say, hey, this is good value, and we start stepping in. So we'll see as prices start sliding, maybe we start seeing more sales pick up. And that's a possibility then that maybe we are getting to that value zone where those end users feel comfortable enough to step into the long side of this market and buy some grain.
So we've pointed at the funds for a lot of the selling pressure in this market, and they're so short in corn and soybeans, near to record short. But it's not just about the funds, is it?
No, we're very concerned right now as we move into the August window here with what's going to happen in terms of this old crop corn and soybeans that are still out there. We're still, forget back to that June grain stocks report. We had 3 billion bushels of corn in producers' hands, so that's going to hopefully be moving out here, or has been moving out up to this window. Now we're kind of getting to that crunch time. We got September basis contracts that'll have to get priced out here before the end of the month, as well as just producers getting corn out of the bin or beans out of the bin to get ready for fall harvest. And this is that window we can typically see that selling pressure. You just look at charts on the historical side. When you've got a heavy crop coming or a good supply coming, we see strong selling pressure here from now until a fall low. And that's what I'm kind of looking at. Again, thinking that 350 handle would be a psychological point that could hold December corn. Again, if we're looking at this, December corn, if we're looking at that September corn, right now charts are pointing to a 340 area low.
What about beans? We're going to go sub 10, you think, on November?
I think very much so at this time frame. It just feels like that's happening at this frame. I think 950 is an area that would be a psychological stop. The biggest thing is what's going to happen with some of these yield numbers, carry out numbers, and those types of projections. We already know that soybean demand is at a 24-year low for new crop sales. I think the USDA has overstated the current demand levels for the 24-25 marketing year in terms of exports. So we could shave some things off of that side real quickly and add the carryover, throw in above trend line yield. Things could look at ugly really quick. I wouldn't say $9 is out of the question. That might be something we look at as we get closer to the end of the winter or even into the early spring.
Yeah, certainly not good news there. So we did have a little uptick today, as I mentioned off the top of the show. Was that just a short covering bounce because we're oversold here? Or do we have this bigger crop in the U.S. kind of starting to be priced in? Or
we got a couple things working there. First off, watching what's going on with the Métis for the milling wheat prices in Europe. French crop conditions are at a multi-year low here, and we're seeing some poor quality due to excess wetness, here around this harvest window. I think that's helping support prices a little bit. We still got a lot of questions on the global scale in terms of, what's the Russian wheat supply, what's available for export, what's happening in terms of those European supplies. So those are things that I think the market may be a little bit cautious about. Yeah, obviously coming back to the United States, you're looking at a spring wheat crop, 74% good to excellent. You got an SRW crop that, from just talking to producers, sounds like it's going to be a monster. So those things I still think are in front of us here as we continue forward. I know seasonally we got a sell window for that SRW contract, or that Chicago contract, coming up in the next week or so.
And what about demand? Do you think we are stimulating demand at these levels on wheat or not?
It's been up and down in that regard. I mean, we export sales this week were nothing to jump up and down about. It was a solid number within expectations. We've had a couple very good weeks in here, so it's going to be just basically on the flow in terms of what's needed on the global scale. Obviously, if the world supplies are still plentiful enough to meet the current global demand, and we got heavy supplies here, the biggest problem for wheat for us is we're not one of those top exporters. We're down the line, so people will usually go to other sources before they turn to the United States. In that case, that means prices will likely have to come down to maybe draw that business even more.
Not a good day technically for the cattle market as we were down. We had lower cash and cutout values. Was that the problem, or are we starting to roll over?
We got a bunch of pieces in the puzzle today. First off, one thing I think was a big factor in live cattle side, August options expiration is tomorrow. So you see these volatile movements around those windows sometimes as the market goes after, today would have cleaned up a lot of long calls. Tomorrow, maybe it goes back after the puts and we come right back. I'm not sure. We'll see how the day goes. Follow through will be the key after a day like today. But then throw on top of that cash trade, steadied a little bit softer. That's at least what the early indications are. Really not enough to establish a major trend at this time. But then watching retail prices, thought we were maybe getting a little bounce, but we're back down again about $1.50 today at midday. Do we get some bounce for Labor Day demand? That's going to be coming up here in the next week or so. But I'm getting a little cautious. This cattle market, especially with that move in feeders today, breaking through that bottom side, just kind of opens these charts up for some more selling. I mean, we've been on this run realistically since 2020. Charts are looking tired on those long-term charts. So it's a bit of a nervous window here. Even though the fundamentals may not merit it, the market technically could see some recovery, kind of like we saw last fall.
Yeah, I wondered if the charts weren't getting a little tired. What about the hog market? We are seeing a higher close today, but the cutouts have really been pushing that market, don't you think?
Yeah, very nice jump in retail values today, $1.07 on pork carcasses. That'll bleed over into the cash market as well. We're seeing some pretty good movement in that October contract as August is getting closer to expiration here. Pretty big gap between the two in prices, so that might be something we're seeing play out here. It's just some narrowing up of that spread between August and October, and that's trickling through into those back months. So it's a window right now. We had a hard sell-off. We had a bit of a price recovery. Now we've kind of corrected off that. Now the question is, do we continue to run higher, or we get back to that turnaround point from just a few days ago and hit a wall? So I think the next couple of days here in that hog market will be key for price direction as we move further into the fall.
All right, thanks, John Heinberg with Total Farm Marketing. That is Markets Now.